Well, this is going to be rather a light week this week because I think there's just really a few big things to pay attention to because late last week a narrative got a hold of the market and um, with a couple of confirming points that just seemed to run into Friday's sell-off, which I think is part of the tone that we might probably experience throughout June and July. Here's the change in rates over the last week. Really interesting stuff here. Let's look at money market rates. That's up to 1 year. Here are the June 3rd rates. At the very top here, I put the year-to-date high at the highest point that rate for any particular key rate has been for the year. All money market rates hit the highest they've ever hit as of June the 3rd. And I think this came primarily from the central bankers' comments from Brainerd and Mester, which we'll look at in a little bit. But they are the highest they've ever been for this year. They've hit year-to-date highs. For capital markets, we can see they've all been increased. This eliminates 3 weeks of decreases in rates. We're reversing that now. And up here I have the year-to-date highs for the 2 and the 3 year. It happened on May the 3rd. For all the others was May the 6th. So we're anywhere from 8 to 14 basis points below the year-to-date highs in capital market key rates, but we've already gotten there in money market rates. So if we breach these highs, that is going to be very negative for equity markets. Our slope as of June 3rd, we are not inverted anywhere along the line. The 2 to 10 is the key one to look at. And when we say inverted, it doesn't mean you invert by 1 basis point for a couple of days and that's it. We've had the curve inversion and here we go. It's in the record books now. It's a significant enough inversion, not just 1 or 2 basis points. And even though inverted yield curves don't hang out for very long, they do hang out for more than a day or two. So it's not enough to see a negative sign on the 2s to 10s by 1 or 2 basis points for a couple of minutes or an hour or a day and say, there it is, there's the inversion. Let's mark that line in the sand, and 2 to 3 quarters out, let's plan our recession. It's not that hair trigger sensitive. It has to be a significant inversion by at least 25, 30, 40 basis points for a period of time, whether it be a 2 or 3 week period. Certainly not a 2 month, 3 month period of 100 basis point inversion. That's way too much, but significantly long enough that it affects behavior. But just, I've heard some commenters on Bloomberg last week saying, well, we've already had the curve inversion. It's like, well, no, technically, if you want to talk about it in a mathematical sense, sure. But that was for a very brief period of time, and it was minor in the number of basis points. It doesn't really count as an inversion. I would not count it as an inversion at all. So I don't think that we've had the recession signaling curve inversion at this point in time. Yes, we've had a curve inversion, but I don't think it was a recession signaling curve inversion. We just don't have that. FOMC meeting June 15th. This is pretty much a guaranteed 50 basis points, pretty much in the books. And balance sheet runoff has already begun, so we'll see what the statement says about that. I don't anticipate any changes in the pace. I think the pace will be what the pace will be. So it'll be just the language of their 50 basis point hike in terms of are they projecting how many more of these? It doesn't seem like there is going to be a September pause based on what some of the Fed officials said last week. So there might be 1 or 2 more, but I think that'll be looked at, and in terms of how long the pace will continue. The other thing to look at is what the year-end forecast will be for the Fed funds rate. based on the statement, if we get any information in terms of where the dot plot is and where we can infer the end of year rate to be. That will be interesting to see. Just to get an idea where the December federal funds futures contract is sitting. Last Friday we were in this zone here, finished I think around 97.47 or 2.53%. We are finishing, I think the closing price was 97.285, which is 2.715%. So from 2.53 to 2.71, roughly about 18 basis points higher for the end of the year, or at least the market is pricing in for the end of the year on the federal funds futures. Let's have a look at our real yields and our break-even rates. And another curiosity here on the break-even rates. Again, year-to-date highs across the top here. On the 2-year, the only one that's negative 9 basis points. The highest it got was negative 2 basis points. And the one to pay attention to mostly is the 10-year, 22 basis points positive. It's been much higher than that historically. That's what I've got on the chart down here. The blue line here is the yield on U.S. Treasury securities at a 10-year constant maturity inflation indexed. So that would be your real yield on the blue line here. We were negative 2012, 2013, and then negative after the pandemic. But previous to that, we had positive real yields. Not a lot, but we had positive real yields. This is 2.5% here, 0% here. So somewhere below 2.5, we could say maybe just a little below 1.3% through this whole term. 130 basis points, we're at 22, and during this period of time, 2014, 2000 to end of 2018, 2019, markets made their way up. So it's not as if real yields are a threat to the market per se. They offer competition in terms of if I think the market is too risky right now because it's not pricing in enough of the risk. A real yield does offer significant competition to the market because you can get 22 basis points of real yield and your capital is inflation protected and it's tied to the CPI. So you're going to get that on your capital. And if inflation does come back down and yields moderate, those securities can show some good capital appreciation. So I don't know that 22, I would get too concerned about 22. I think you'd have to see it over 100 basis points before it really starts to be a threat. Right now, it's not that interesting, although at the margin, it probably is sucking some money away from where equities can be. But I would watch this, and especially watch it if it breaks these year-to-date highs. That would probably depress equity prices. Break-even rates have all increased, which seems, again, curious to me, with a concern that rates are going to keep going higher and higher than market participants had factored in over the last 3 weeks with the moderating of rates. You would think that it would have pulled back a bit. So what I think is going on is I don't think that there's a lot of trading from the break-even rate. Well, actually, that's the change. I don't think there's a lot of trading from the break-even rate outward to tips or to nominal securities. I don't think that a lot of market participants are looking at the 10-year saying 2.74. I believe that is too high. And since that is too high on the break-even, let's buy the nominal. Because anything, if you think it's too high, then the nominal is probably got a better yield. And the 274 is the indifference point, right? If you think it's going to be higher than 274, you're going to buy the real yield. If you think it'll be lower, you'll buy the nominal yield. If that were the case, if they were trading out from that point, nominal yields wouldn't have increased by as much. So I find this again odd, and the only conclusion I reach on this is I don't think trades are being made from the expectations back to the bonds. I think trades are being made in the bonds that then create the expectations, and they are what they are. So I don't know if that's the case. I don't know that there's a lot of information content in break-even rates if they're simply just an outcome of other decisions being made as opposed to decisions being made from the break-even rates backwards. Let's have a look at this thing down here. What I've done is I've taken in the green line here is the Fed balance sheet, but to fit it on the same chart, I divided it by 1,000,000. So it fits on the same chart, so we could just sort of see the growth of the balance sheet in relation to nominal 10-year yield, which is the brown line, and real 10-year yield, which is the blue line, and we see that they move fairly close together. Inflation expectations haven't really diverged that much. A little bit here where the 10-year real rate, this was at the end of December. There was a period, December of 08 to somewhere around February of 08, during this period of time in here, where the real yield was higher than the nominal yield. So it was pricing in negative inflation or deflation. And then from March 9th onwards of 2010, March 9th, if you remember that day, it was a Monday. March 6th, the Friday, the market hit the lowest point it had ever been. I think the S&P was at 660 something. And then in pre-market on Monday, Citigroup came out and announced that it would its earnings would be positive, that it was forecasting positive earnings, and then that was the beginning of the rally that just never ended from that point. That was the low of the market, the closing on Friday, and then Monday we just went up from there. So March 9th tends to be a turning point in the yields, for both the real yield and the nominal yield here. So this overlap here is this period of time. And then it held a fairly consistent spread between the two for quite some time. And it's doing that here, although this is turning up a little bit more. As far as nominal yields are concerned, we've been here before. We're not in any place that we haven't been before. And as far as real yields go, we're not in any place we haven't been before. We seem to have a fairly constant regime here to match the balance sheet regime. So let's do that. If we look at, let me see if I can get rid of a lot of these lines that I drew on here so that we can clean this up a little bit more. I like this back button I have at the top. It can clean things up kind of nicely. Let's see what else I can clean up here. That's about as far as I can go. All right, look at in this period right here. It seemed fairly constant. But you had a constant size on the balance sheet. This is in response to the financial crisis, 2008, 2009. And it didn't really increase that much from there. It drifted up a little bit, but rates really didn't do too much during that period of time. You had another increase here, and you had a period of sort of stability here, and during that time you had a period of stability there as well. And it wasn't until here that it, from this point onwards, where it really seemed to get way out of control. If we go back to December of 2002, 0.7 trillion. And that was all the way to August of 08, 0.9 trillion. It really didn't increase that much over 6 years. During this period of time, 2014, 2019, it oscillated in here in between 4.4 and 4.5 trillion. And in a short period of time, it's basically doubled to almost 9 trillion. We're at 8.9 trillion at this point. This line here, by the way, in case you're wondering what that is, just follow this green line, put that in perspective all the way through, and then look at where this pink line is sitting in comparison to the green line. If the Fed reduces the balance sheet by the amounts that it says that it's going to do over the next 3 months, and then doubling both those numbers for the next 9 months, the 1-year target for the balance sheet will go from 8.9 trillion down to 7.9 trillion. 1 trillion will roll off the balance sheet. That still puts us way up here. Based on where the balance sheet has been, that is, even though the Fed is removing liquidity at such a slow rate. I have a 16,000 gallon pool in my backyard, and if I drain it by 1/4 of an inch a week, over the course of the summer, you're barely going to notice it draining. Yeah, I'm draining it. Every week there's going to be less and less water, but it's not going to affect any of the swimming for a long time to come. So the idea that a drop from here to here is equivalent to some kind of monetary tightening, I just can't see it. If you were really trying to remove liquidity, if you were really serious, you would be trying to get it back to this level over here, which would be cutting the balance sheet down by 50% over the course of the year. This 1 trillion, when you're at 9 trillion, 1 trillion is like, well, 11% decrease. Sure, okay, it's a decrease, but when you put it in perspective, it's just not that much. So, again, over here, this is, the market thinks relatively, right? We were here, now we're here. That's a huge change. But when you step back for a while and you draw this line straight out, there have been huge periods of times where real yields have been higher than 22 basis points, and especially for the Treasury, if you draw it back, there's been periods of time where the Treasury has been significantly higher. And the balance sheet has been significantly lower, 4.4 to 4.5 trillion during this period of time. Look at where real yields were, anywhere from 0 to 120, 130 basis points positive. The 10-year between 2.7 to 2.3 on the low end, with half the size of the balance sheet. And look at the market. Market went up during that period of time. So I don't know that that we can say, okay, well, now you're reversing, you're raising rates from a low level and you're reducing the size of the balance sheet. The bands are so wide on that. Rates are so low and the balance sheet is so high that even if you change it by a significant factor, you've still got a lot of room in there, a lot of accommodative policy and a lot of liquidity still behind the market. So I'm not seeing that its absolute levels are really that troublesome. The market is, I think, interpreting it more in terms of relative levels. Relatively, we were here, now we're here. We were at 25 basis points at the beginning of the year, 20 basis points. We're sitting at 100 basis points now. That's 5 times higher. Yeah, but 100 basis points in perspective isn't when you look at previous periods during which we had growth, it wasn't threatening. Okay, let's look at the housing market. And I got a question this week of why I spend so much time on the housing market, why I include it and spend so much time on it. It's because housing is the most interest rate sensitive sector in the economy, right ahead of all the other durable goods, with autos being the other big one. If we were in a normal market, we would be looking at any downturn in housing to signify demand destruction, that consumers are holding back. Same with autos. We would look for drops in auto sales to say, aha, these higher rates are working. And if you can bring people away from autos and cars, you can do a lot to reduce inflation, because a house requires so much. All the raw materials, all the lumber, the copper, the roofing tiles, the windows, the doors, the flooring, the appliances. When somebody buys a house, all of the new furniture they tend to put in there. There's a lot that goes into a house, a lot of demand for other things that happen when a house is being built. Also, employment, a huge driver of employment in terms of plumbers, electricians, bricklayers, construction workers, carpenters. It's actually huge. So if you can affect those sectors, same with automobiles. Think of the supply chain for autos and all the supply that has to happen. So if you can pull sales down from 17 million down to 15 million or 14 million per year in the US, you can really reduce a lot of inflationary pressure. The problem of where we are now is the housing market and the auto market are so supply constrained that you're already at such low levels that you have lineups for housing, you have lineups for cars. So you have to do a lot of demand destruction just to destroy the lineup. Never mind about the actual demand happening in the market. You've got to destroy the lineup first. Everybody waiting in line, you've got to deter them, and they've got to say, oh, well, you got to make them tap out first. So let's look at where we are with housing. And there is some slight improvement on this chart way down here, and that's it. That's the only slight improvement that we have. 30-year fixed, 5.44%. Mortgage applications from the last week dropped 2.3%. Refis were down 5.5%. Honestly, there's nothing interesting there to see. Of course, the refi market will be down. We're going to look at some mortgage origination companies. Well, we're going to look at one, the largest mortgage origination company in the U.S., and we're going to see that this affects mortgage origination companies. The refi affects that, but it's not really surprising given 5.44. And if you're a holder of MBS, this is important because what this does is it lengthens your duration as the refi index drops, because your prepayments slow right down, and it lengthens the duration of that MBS. Which makes it more price sensitive. Purchase index down 0.6%. Hardly, you can call that unchanged. This is the active listing count, up 8%. That's an 8% right here, year over year in May of 22. So there's May of 22, which is the yellow line. May of 2021, right here is the green line. Active listings are 8% higher than they were last year, and it's this upturn here that seems to be exciting. It's like, aha, it's doing its job. The active listing count is increasing. More people are bringing their house to the market and selling it now before things get too bad. And more buyers are pulling away from the market, which is also allowing these listings to increase as opposed to them disappearing very quickly. But let's put things in perspective, shall we? There's 2020. This is 1 million. This is 1,000, 1 million. We're at 516,000 down here. 516,000. 2020 was 1 million. And then you have 2019, or there's 2018 here, 2019, and 2017 all clustering up here, which is around 1.2 to 1.3 million. 1.2 to 1.3 million. We're at 516 down here in active listings. Pre-pandemic, 17, 18, 19, they're all fairly close together. These three lines are so very close together, other than, year-on-year anomalies. You could say they basically represent the same band in there. This is standard deviations below the band, and this is multiple standard deviations below what standard deviations below we are here. So yeah, sure, it's turned up, but it's 516 versus 1.2 to 1.3 million historically, and you have annual household formation of about 1.2 million per year. So while these listings sort of met all of that household formation, it's not doing it now. Average price, it is just still expanding, going up, and if you look at the slope of our yellow line here, which is 2022, and you look at the slope of the green line over that same period of time, they are different slopes. So while prices were increasing last year, they're increasing at an even sharper rate this year. 17.86% year over year for the same month. If you go all the way to May 2020, which is over here, it's up 35.4%. Yeah, that is ridiculous that you could buy, the average home price is up 35% in just 2 years. You're not going to get any argument out of me that it's ridiculous. I look at what some homes are selling for in this region, and I can't believe it. I've told this story before. I hated paying the price I paid for my home 3 years ago. But it is more than doubled in price in those 3 years. That I could walk away with more than double of what I paid. There is no way that that is a reasonable return. And I wonder who is buying these homes. But even in our neighborhood here, I'll see a for sale sign. You drive by the next week, you see a sold sign on it. That quick. So the market is still there. And this is showing that, yeah, it's still going. And average, this is the days on the market, just sitting a little above 30. It's 6 days less year over year. And to put it in perspective, look at a well-supplied market. Anywhere from 60 to 70 days on the market. It's less than half of that now, with 35% increase. We're way down here in terms of the active listings. For me to see this market rolling over, I need to see this in days on the market. I need to see that turn up. I need to see this. Let's forget about this happening, okay? That's not going to happen given where we are down here. But you need to see this happen. You need to see at least the slope of the increase being less than the slope of the increase last year. You need to see that happen. I'm not seeing that. I'm seeing the slope of the increase greater than it was last year. I'm seeing days on the market 6 lower than it was. Sure, there are more active listings. Yes, we have a higher mortgage rate, but it doesn't seem to be doing very much. So, to sum up, yeah, higher rates and higher home prices. The Fed has been pretty good at getting the higher rates, but it shouldn't have resulted in higher home prices. But you have low inventory and fast turnover. Low inventory, fast turnover, accelerating price still. So the conclusion here for the housing market is growth in prices may slow, but still grow. That's why I say, don't count on this happening. It's still going to grow, but we just need the slope to be less than this slope over here. And if we can get the growth slowing, that's a sign that something is going on. But you really have to get this doing this. And you have to get this turning up before you get this turning down. So I would not look for any decrease, any significant decrease in the national average. Now, you may find markets that are turning over. In fact, they said there were price reductions in some markets, price reductions from the listing price. There were 10.5% of the listings had price reductions in May versus 6.2 last May with Austin. I think Las Vegas, and I forget the third city. There were 3 cities that had the largest amount of price reductions from the original listing price. So yeah, you unless you get this and you get this, you're not going to get a drop in price. So if you're sort of thinking, well, the prices are going to give way, let's wait for the prices to moderate before I get into the home builders, I wouldn't look for prices to drop as a signal for it's time to get into home builders. I would be looking for input costs and labor markets and supply channels to improve as a sign that you're ready to get into the home builders, because until you get supply up, you're going to have these kind of prices. Okay, this chart up here. Here's our mortgage market index. This includes both all mortgages, the market for mortgages, whether it be refinancing or for a new purchase, down 60%. This is a 1 year chart, down 60%. This is RKT, Rocket Mortgage, which is the largest mortgage originator in the U.S., at least the largest one I could find. Revenues of $13.2 billion. Net income of $6 billion. They are profitable. Here's their 1 year chart. They're sitting at $8.59. They're down 61.5 to 61.5% in a year. Mortgage market index is down 60% because they're originators and there just aren't mortgages being originated, and that is reflected in their analyst rankings. One buy, which is down here with a $9 price target, 13 holds and 25 sells. 2 sells. These sells are thinking that the mortgage market index has got further downside to it. It's the lowest it's been in quite some time. And the rest are holds, saying, well, you know, the damage is done. You're down 60%. The damage is done. There's no point selling it. No point buying it, but no point selling it. Average price target 871. We're at 859. You got an average target here of 854. These are different rankings, by the way. I just grabbed a whole bunch, or just two. This is just the average consensus. This is a TIPS analyst forecast. And I have the most recent ones here, and you can see who put the ratings on them here. 7, 9. We have an 8, an 11, a 9, a 9, 9, 7, 7, and of course this is 5 days ago, 13 days ago, 17. That makes sense. When you have this coming down, you got mortgage originators, they're going to sell off. So is this the time to get in? The only time you're going to want to get into this is if you think that this is going to start to turn up, which means refinances are going to start to increase. Well, that's not going to happen for some time. And you think the purchase market is going to increase. Well, until inventories start increasing and mortgage rates start moderating, that's not going to happen for some time now. So if you're looking at mortgage originators, I would say, you know, the hold over here makes a lot more sense. That if you're not in them, don't get in them. If you're in them, well, the damage is done. You may as well just stay put. On Friday, we had the jobs report, which was the big economic data point last week. Next week, there's only one really big economic data point, and that is CPI on Friday. On, I believe it's Monday at 3, we get consumer credit. I don't expect to see any market changing numbers on that. I think it'll probably grow and come in unsurprising. So really next week our big risk is next Friday for CPI. But this was employment came in better than expected, which means the labor market is still too hot for the Fed's liking. So those rate increases are going to keep going. And I've just clipped a few paragraphs from the report. Total payroll employment rose by 390. Unemployment rate still at 3.6. Notable job gains occurred in leisure and hospitality. It was up 84,000. Professional and business services was up 75,000. Transportation and warehousing was up 47. And employment in retail trade declined. And we'll look at retail trade down here. Some other noticeable increases: wholesale trade up 14,000, construction up 36,000. Well, that is good for housing. I just don't know if that is well below what it needs, but any kind of improvement is helpful at this point. Education, both government and non-government education, up 69,000. Healthcare up 28, manufacturing up 18, mining up 6. By the way, these gains right here, manufacturing, mining, wholesale trade, and construction, this is not pointing to an impending recession. These are cyclical industries that if we were expecting a recession, we would start to see either no gains here or some negative gains, especially manufacturing and mining. But we're not seeing that at all. So the talk about, a recession, okay, But let's put that in context. Let's go out 3 quarters, 9 months, or maybe 12 months, maybe first quarter of 2023, second quarter of 2023. Technically, if we print a negative GDP print for Q2, that is a recession, 2 quarters. By the old business cycle dating methodology, 2 quarters of negative GDP. But you really have to go back to Q1 GDP and say, well, hang on a second now. This is a structural issue, that all of that inventory, all of those imports landed in the first quarter of 2022. That over-ordering of goods that we saw from Walmart, we saw from Target, you saw from American Eagle, you saw from Overstock.com, all of them saying inventory levels are everybody's flush with inventory, too much inventory out there. That is an anomaly that I would not, if you did get a negative print for Q2, I would not look at Q1 and say that was negative. I'm still saying, look, those imports should have landed uniformly over past quarters. They didn't. They all just sort of bottled up all at one time and came in all at one time. You're concentrating everything into one quarter. It's unfair. I don't think that Q2 is going to have a negative print, by the way. And I would be very it wouldn't take much to convince me to remove the negative sign from Q1. Let's look at retail trade, because we saw this with Target, we saw this with Walmart, Amazon said the same thing. We expanded way too much. We were a little bit too aggressive in hiring. And they were going to let people go either through attrition or through saying, okay, look, we don't need you anymore. So employment and retail trade we would expect to have declined. It would be consistent with what we saw in Q1 earnings reports. 61,000 down in May, but is 159 above its February 2020 level. This was the month before the pandemic hit. You're 159 above that level, even though it did decrease. General merchandise stores, 33,000. Clothing and clothing accessory stores, negative 9,000. And when we look at CPI, this is where we're seeing the negative sign in terms of price change month over month is clothing. Apparel, you saw a lot of negative signs there. The hard lines and the textiles within the merchandising store were showing negative prices month over month. Being deflationary. Food and beverage stores down 8,000. Building material and garden supply down 7,000. This, I have to wonder whether it was that they were overemployed, or if it's just a matter of, look, you can't get the stuff anyways. We just don't need this many people if you can't get the inventory. And health and personal care stores down 5,000. Average hourly earnings, 5.2% year over year versus 4.9% for core PCE. But since this is average hourly earnings and people have to buy food and they have to buy or pay for energy, you really have to compare it with the 6.3%. So their real earnings adjusted for that. For the change in the price level is decreasing. Again, I'm using PCE, not inflation, not the CPI, not the price level, but the cost of living index. So they are underperforming here. Participation rate 62.3%, still about 200 basis points below the pre-pandemic level of 65.5. I don't know that we're going to get back there anytime soon. For retirees, this has been going on for 10 years now, started in 2010. 2010, baby boomers, which were born between 45 and 65, hit 65 between 2010 and 2030. And it is a large cohort that you have 10,000 a day hitting retirement age at 65. So you need at least 10,000 a day coming in from the younger generations just to keep the labor force at a constant size, not a shrinking size. The employment levels, even though our participation rate is lower and wages are higher than pre-pandemic, the amount of employment, when you count the employed and unemployed, is lower than pre-pandemic. So the labor force size is smaller. Employment levels more and more likely not to return to pre-pandemic levels. I don't think this participation rate is going to get back to the 65, and I don't think that the jobs that were lost are going to come back anytime soon, simply because you've got this massive headwind of 10,000 a day that are retiring, which means you need 300,000 a month entering into the labor force just to offset those that are retiring, just to stay constant. A lot of talk about deglobalization and onshoring for the U.S. It looks like it's becoming more unlikely because you don't have the employment numbers here. I say immigration, that is a solution. That's a solution Canada follows. It's one of the more immigration-friendly countries globally. It follows that route. I don't know, given the politically charged environment in the U.S., that is something that any politician wants to make a stand on at this point. So I'm not sure that this is a problem that is going to be easily solved. The beneficiary of this, by the way, is going to be Mexico. If you don't want Mexican immigrants coming into the U.S., well, then you can send jobs to Mexico where they are, and hence they would have no reason to leave. If you look at the Mexican peso over the last quarter, over the last 90 days, it has really performed well. So whether those gains can continue, I don't know. But given where the U.S. is in terms of its labor force, and I think a stable to shrinking labor force at least over the next 10 years, I don't see it improving that much. That Mexico may be the beneficiary of that one. Non-farm productivity in Q1 down 7.3%. So when you combine your wage gains with your lower output, that's productivity, unit labor costs. That is your lower output with higher costs. Your unit labor costs up 12.6%. Well, that's going to hit margins. It has to. There's just how do you not have it hit margins unless you can fully pass it through, thereby creating the very wage inflation that you're trying to avoid, which would then lower unit costs, which would push unit labor costs even higher. What I just described there is called a wage price spiral. When we think about, I'm just going to clear the screen a little bit because I want to draw something out for you. When we think about inflation, whether it be supply or demand, I'm going to draw out just the typical type of supply and demand curves you would see in your first year university textbook, where you have supply and you have demand, and in equilibrium you have an equilibrium price and an equilibrium quantity. Supply and demand. Demand, supply. Demand is downward sloping. Supply upward sloping. When you have an increase in aggregate demand, usually it looks like this. And you will get a higher price level at a higher level of output. There's P1, there's Q1. And so when you have increasing output on increasing pricing, it's easy to see that you have increased demand. How do we know that we have increased demand at this point in time? Actually, we wouldn't be there. We're out here at first before we move up to this point to get into another equilibrium. How do we know we're over at this point? Is we can look at capacity utilization. Typically, if you're above like 82%, and it's the 82 to 85% range, that suggests that demand has increased for a given level of supply. Because in the short term, we can think of supply as being rather fixed in terms of capacity. If we're just talking about goods now, services is a lot more flexible. We're sitting at 78.6%. Industrial capacity utilization. Anything below 80 is still got some utilization, some potential that we could use before inflationary pressures show up. But we have inflationary pressure. So this scenario doesn't seem very reasonable. Let's do it another way. Here is our supply, here's our demand, here's our equilibrium again, and let's see if we can model something that looks a bit more realistic, that lines up with the capacity utilization that we have, that lines up with a labor force that is smaller than pre-pandemic with wage increases, where we end up with auto sales that are 5 million below the 2016-2017 annual run rates of 17.5 million. We're sitting at 12.5 million, but auto prices have never been higher. Where we can have home prices that are still accelerating, but home construction has never been lower. How can you end up with a situation like that? Is when you have, instead of demand shifting outwards at every point, you have supply shifting inwards. And if you have a supply shift inwards, you'll get your higher price at lower output. Well, there's your autos. There are your homes. Explains a lot. There's P2. I'll put that as PE for equilibrium. So there we are. And what's needed to get back to equilibrium here, what's needed to get to bring us back to a point of equilibrium is a drop in demand. You have to work on demand. Here, I don't know that you had a expansion of demand at a national level. If you break it down into goods and services, you did have that for a while. You had an increase in demand along with a contraction in supply at the same time, which really pushed prices up. Because supply was contracting right as demand was increasing for goods. While when you have demand that's falling over to services, demand is falling back into where it historically had been. However, supply has yet to find its way back. So that is more in line with the evidence of where we are now when we look at capacity utilization, when we look at employment levels. If you look at participation rates, you look at auto sales, the run rate on auto sales, the run rate on home sales. If you didn't know the price level, if I didn't tell you prices, you would say this looks like an economy in recession. The central bank must have raised rates. Inflation must be very low, especially to get auto sales down to 12.6. Unemployment must be 10, 9, 10, 11%. If it were demand induced, but being that it is supply induced, this is sort of where we are now. We do have higher output, so we do have some demand that has happened. Let me see if I can redraw that for you to show a decrease in supply with an increase in demand, what that would do. So let's have our demand, let's have our supply, let's contract our supply to here, and let us increase our demand over to let's say here. So we had an original equilibrium here, and now we have, here we are. So we do have a slight real increase. This is real GDP on this side, and this is our price level on this side. So we have had a increase in output and an increase in prices as well. Okay, this was the narrative that the market was dealing with last week, which seemed to come very quickly near the end of the week. Jamie Dimon, hurricane coming. But he didn't say a hurricane is coming, batten down the hatches, hide for cover. He said a hurricane is coming. He just doesn't know if it's a minor one or a major one. Yeah, there's some trouble ahead. It could be some minor trouble, or it could be really bad. He didn't say it was going to be real bad, but he used the word hurricane. He just should have said there are storm clouds on the horizon. Whether it's going to be a bad storm or a hurricane, I don't know. And I think if he said it that way, he'd probably say, well, that's exactly what I meant. It just, he started with the word hurricane, and well, that's all it took, right? And he did say 6 to 9 months out. 6 to 9 months out, not tomorrow. Other things he said, he sees oil somewhere between 150 and 170 here the benchmark would probably be Brent, because that is the European benchmark. Grains, upward pressure, significant disruptions in supply channels for grains, significant disruptions in the market for grains as well, which would push the price higher. First of all, getting the seed in the ground. Secondly, getting the harvest out of the ground. And third, actually shipping it to different places. And some countries are going to be significantly hurt because of that. Northern African countries, especially Egypt, which relied on European grains for pretty much all its imports, significantly hurt. The whole Middle Eastern region significantly hurt. Well, that's part of the global GDP and global growth story. The U.S. can't go it alone, so, okay, there's something there to look at. Elon Musk, on his Thursday night email, which came at a kind of a peculiar time, and I got a theory, so I'll explain my theory here. Earlier in the week, he told everybody, get back to the office or just stay home unemployed. If you got a job, you're going to be in for the work at home means at least 40 hours in the office, and then you're free to work at home as much as you want, but 40 hours in the office. Come home or just don't come back, is what he said. He's had enough of it. And then on Thursday night, he sent out an email, cut 10% staff because he has a super bad feeling about the economy. And I think this super bad feeling provides cover. Let's blame it on the economy. I think he's a very frustrated person, and I would agree with him on some respects. Working with a staff that stays at home is a lot of, where are we on this? Where are we on that? We talked about this last week. Where are we now? Where are we here? And it can be frustrating when you want to move at a certain pace and it's just not happening. That every time you want to schedule a meeting, it's like I'm busy here, busy there. It's a Monday. How about a Thursday afternoon? Thursday, I want to talk right now. When it's in the office, you just walk past the person's office and you walk into it, period, and you just start talking. Well, when you have to schedule all of your conversations, all of your, scrum sessions, it doesn't work out very well. I get it. It's got to be frustrating. Let's just have a look at some of the things that are going on that he is completely aware of. They announced back in 2018, 2019 about the EV truck. Well, Ford beat them. They still don't have a truck, and Ford's already shipping the F-150. GM's already shipping the Hummer. They beat them. On Thursday night in San Francisco, GM got its final permit. It can now charge for rides in Cruise, its driverless car. So you get in a vehicle that has no driver and it'll drive you around, and it can charge for it now. Well, Tesla was talking about this a couple years ago, that by the end of 2021 they would have a fleet of this out. Well, GM beat them. Ford beat them to the truck. The National Highway and Safety Association is looking into their braking issue, something like 758 complaints, which is double, I think, a normal, what they've had previously. 758, and Tesla has till June 20th to respond to this issue. And this is an issue in China as well. That's you remember that car show at one point where somebody stood on the top of a Tesla car screaming about the brakes, how it just brakes for no reason. Well, this 758, that's just in the U.S., so they've got this, breathing down their neck. Not only that, every single automaker in the world has announced plans for an EV or has an EV, is rolling out an EV, building factories, taking supply off the market. They're coming in. Competition is coming in from all corners. In Shanghai, that during April, they were only able to produce 1,512 units, down 98%. May deliveries were 33 for all of China, 33,463. April, 25,845. March was 35. So you went from March down to April, 10,000 fewer deliveries. May, you had a rebuild, but you didn't get to the 35. The Chinese EV makers are by far delivering more vehicles in China right now. So when you think about wanting to get things done, when you're a person of action, when you're an entrepreneur, when your brain runs at a certain speed and you have to keep constantly saying, where are we on this? Where are we on that? How much progress? Where are we? Well, let's get a meeting. Let's get a meeting. Let's get a meeting. At that point you're saying, okay, you know what? This is not working for me. Everybody's in the office or you're not, because it's not working for me anymore. And then on Thursday night, when GM got its first beat him to the robo-taxi. Not only that, earlier in the day, GM announced a $6,000 price drop on the Bolt, making it the cheapest EV in the US at $25K, versus the Model 3, I think, is at $46K in the US. So he's seeing this happening, a price war happening at the lower end, and that's what the Ford CEO said as well, that he anticipates a price war at the low end of the market. And sure enough, it's already starting. The Bolt down to 25. Ford is going to follow suit, and a bunch of other companies already have lower priced EVs. He's got competition coming in on his mass market vehicle. He's got a bloated administrative staff. He's way behind on the things that he promised. He's got a braking issue breathing down his neck. He's got a discrimination issue breathing down his neck in California. He's got competition coming in from all sides. China is underperforming. I've had enough of it, he says. I would be the same way. And then, the Thursday when GM started the day by saying the Bolt's going to be cheaper. And guess what? We're the first to this at that time. It was 11 o'clock at night, I think he sent it out. It's like, okay, enough is enough. Enough is enough. We have to compete somehow. He can see the storm clouds. And for him, the economy is Tesla. For him, that's it. That's the whole economy. You think he goes to the grocery store and looks at prices and says, oh my God, I can't believe the price of cabbage. That's me. I can't believe the price of cabbage. I still go to the grocery store, but I don't think he's going to the grocery store. For him, the economy is Tesla, and I think the economy is providing cover to cut that staff at 10% and to start yelling and raising your voice and demanding that action be taken. This is just too much coming in on all sides. Put yourself in his position. Think about it for a minute. The competition is breathing down your neck. The barbarians are at the gate. They're coming in. Supply constraints, COVID lockdowns, quality issues, braking issues, social issues in terms of discrimination in one of your plants. All of these things happening that are not his doing in the sense. He's got to rely on people around him, but these things are happening under his watch, and every time he walks into an office, it's empty. Yeah, I think he lost it. Rightfully, I think he lost it, but I think his frustration is he's got a super bad feeling about Tesla's economic future. I don't think he's got a super bad feeling about the economy. It's just the economy gives him cover. So this one, I don't know that I'd read too much into this, but I'd read it into this, and Tesla's price fell, I think, 9% that day. Brainerd, some Fed speak here. Hard to see the case for a September pause. Said a pause in September would be very hard case to make. Hard to see a case for a September pause. Mester, inflation has not peaked. Even though you've had 3 months of sideways movements on the month-to-month and a moderation on the headline year over year, inflation has not peaked. Multiple 50 basis point hikes are needed. Add it all up. Jamie Dimon, hurricane coming. Elon Musk, super bad feeling about the economy. Cut our staff 10%. Brainerd, we're not going to stop in September. Are you kidding me? Mester, inflation hasn't peaked. Get out of the way. Add that all up. That narrative is coming back. You've got the inflation narrative down here, and you've got the stag narrative coming in up here, over here. So where we go from here, I don't know, but I don't see any upside. And that's why this week is going to be short, because I don't know that there's a lot to talk about other than getting defensive. So let's talk about what that looks like. Okay, this is the 1 year chart of SPY. I use SPY. It's the ETF that tracks the S&P 500. If you want to use futures, you can use ES, which is the S&P Mini. It is for 50 times the index, or you can use SPX, which is the big guy. It's for 250 times the index. Very liquid options on the ES, and the ES trades 24 hours a day. Well, almost 24 hours a day. After I think it shuts down at 5 o'clock, at least with Interactive Brokers at 5 it shuts down and then reopens again at 6 o'clock p.m. and then trades throughout the night. It's not much, there's not a lot of information content in it throughout the night, but if something happens somewhere, at least you have the ability to do something. So you can trade that one outside of regular hours. SPY you can trade till 8 p.m. In extended hours, and you can start trading it as early as 4 a.m. in the morning in extended hours. Forward EPS 235.17. This is a Q2 of 2022 all the way to Q1 of 23. It's the forward 4 quarters. Our June 4th closing was 4108.54, which puts a 17.5 times multiple, a forward multiple on the index. Resistance, I can sort of see a clustering here right around 42.90, and 41.50 to 41.60 seems to have some resistance in there as well. So you have 2 lines of resistance above where we are at 41.08. The 18 times forward is 42.33. So at 425, you could just draw a line through there, 423.30. So I just call it 425. I'm willing to sell calls on the index at 425. Any rally, I will sell calls at 425, and I'm using the September expiration month to sell those calls. The shortness of the video today is because I think there's really only one strategy for the next couple of weeks. Got to see what the Fed says on the 14th. Got to see what CPI print is on Friday. Got to see how the rest of the world plays out as well. Is China done with its lockdowns, or is it going to have another one? The only reason you're shutting down those kind of cities, is still making those kind of shutdowns for major cities, is your vaccine can't work very well in stopping transmission, or if it doesn't work well in stopping transmission, at least doesn't work well in stopping the worst case of the disease. So you shut the whole city down. Well, Omicron is super contagious, more so than any of the other variants. So I don't think they're done. It's not gone. It's not gone away. I don't think they're done. So you have that risk still out there. So I think the only message really is be defensive for the next couple of weeks. You want to be as defensive as you can. I'm not positioning myself for a significant downside. I'm not saying, well, look, I'm going to position myself for 10 or 15% downside, or 3,500, here we come. I don't know. I'm not planning on it. I don't see it at this point in time. The fundamentals don't support it, but the narrative might get you there. However, I feel pretty certain that above this level, if we do get there, it's not going to hold. So that's why I'm willing to sell that part of the distribution. So the strategy to follow for the next couple of weeks is be defensive. And defensive involves 2 things. I'm going to be long some certain names, but I do want to sell the upside return or the upside return distribution on the market. I'm going to move into lower beta securities as much as I can. I've been adding apartment REITs as they've been coming down because they're just a nice place to be. SPYD is a nice place to be. These are very defensive. It's I think 60. It's got 60 components to it, and it is the lowest duration equities in the SPY, and I think it's down a couple of bucks off its 52-week high. It's a nice, safe place to hide. Lower your beta. Get long some certain names that have a low beta. Sometimes you can't get long something that has a low beta. Sometimes something's been beaten up quite a bit that you look at, you say, well, I like it at this price. It has a higher beta than the market, but I like it at this price. That's fine. Low duration, low PE. Make sure you have a low PE on this one. In other words, you're looking for value plays. I say less than 1/3. So whatever their 52-week high price was, are they down at least 33% off their 52-week high? The further they're down, the better, at least the safer it is to be in those names, because the damage has been done. For home builders, I think the majority of the damage has been done. Are they going to recover anytime soon? I don't know, but the damage has been done. And then I'm going to sell the upside return distribution on the market. So I'm going to be long specific names, but short the upside of the market. This lowers my delta dollar beta. So just let's break this down. Dollar beta is just you take your dollar position, whatever your position is. If you have 100 shares at $50, you have $5,000, and if it has a beta of 0.8, you multiply it by 0.8 and you'll get a dollar beta. If you have options, you multiply it by the delta of the options. For stock, the delta is 1. So if this were 100 shares of stock, I would just say 1 times this. It would give me my dollar beta. But if I had options, at the money options, it would be 0.5. My dollar beta, instead of being 4,000, because this would be 4,000 here, my dollar beta would be 2,000. Because if I'm selling the upside return distribution, I'm doing it with options. So I'm going to try to lower this number. Not by lowering my long portfolio, but by selling the upside return distribution on the market above 425. And on some of the names, I may sell some of the upside calls on some of the names. If they have liquid enough options, I can do that, but I'd be more likely to sell on the market than I would on individual names. But on any rally, I probably would sell the upside return distribution on some of these names. Now I can sell this upside return distribution by either being short calls. This gives me an undefined risk profile. Undefined because, well, it could just keep going up and up and up and up. And not only that, your margin requirements are higher with short calls, even though some of your other securities should act as margin in that case. Bear call spreads will lower the amount of margin you need, and you go from undefined to a defined risk profile. So selling a 425 to a 450 would lower your margin requirements. And because all you'd need is just the spread between the 425 and the 450, and it's still a credit spread, and you're still going to lower your exposure. That's what I would do over the next couple of weeks, only because risk is so high. I'm not going to sell everything I have. I'm looking to buy stuff right now that's interesting. I'm looking to buy stuff that's been beaten up quite a bit that I think can rebound quite well. When we get past this thing we got to get past, whatever it happens to be. I don't think apartment buildings are going away. Apartment REITs just seem to be a nice, safe, easy place to hide in. There aren't that many interesting sectors to hide in, and sometimes you don't want to pick names. SPYD has 60 names. You don't have to pick any one particular name. It has a dividend yield and very, very low duration. It has outperformed all markets this year in terms of, it's down, but it's not down a lot. That if you need a place to hide, that's where I would go, and then I would be selling calls on the SPY above a certain point. That's all I have right now, because I don't have any other thoughts to give in this respect. I will say a couple more things here. Let me just erase some real estate here. Actually, let's just do that. We'll get rid of that. The Canadian dollar has really performed well. The Bank of Canada did move 50 basis points as expected. And it doesn't seem that the language it used is suggesting that this is over by any stretch. So the Canadian dollar has shown some strength. It is sitting above 79 cents, but not quite 80. I think we're 79.3, 79.4 cents. It got up to 79.6 before pulling back on Friday's sell-off. Energy, especially oil. Interesting presentation that I listened to this past week. Talked about the possibility of the Biden administration placing an export ban on oil. The U.S. used to have this for a very long time. It was just sometime in the last, I think, 7 or 8 years that they removed the export ban. But there was an export ban on oil. But when it started producing way more oil than what it needed, that was removed. Being that gas prices are so high and you got midterm elections coming up, Biden's going to want to do everything he possibly can to try to make a difference. That I never once thought that, about the possibility of reinstating that export ban. And if that happens, the discount from Brent to WTI would increase. So Brent could keep increasing, but WTI would fall off a little bit before being pulled along with Brent because the spread would widen between the two. So if you are going to play energy, I'd probably be more apt to play Brent futures, which is a European benchmark, as opposed to WTI. If you want to avoid this potential gap widening, and if this does happen, where he reimposes the export ban on WTI, that would just shoot Brent even higher. Gasoline, I still think, is going higher. Because if you looked at the inventories for last week, they went even lower. So I looked at refinery utilization. It's not super high, but it's not low. It is pushing the limits of it's not where it historically had been. It's about 2% below where it was for, let's say, 2013 to the 2018 period. But that doesn't mean that there is significant upside to refinery utilization. And the big story with energy still remains the massive under investment in that space that has happened for the past 10 years, and the lack of willingness of any of the oil majors to spend a single penny on any exploration of any new fields. If I were the CEO of any oil company, I'd be saying, are you kidding me? Why would I ever spend a penny on it now? Every car company in the world has announced an EV and a move to EV. Why would I spend a single penny? So I think things get increasingly ugly with energy, but it's this export ban I didn't think about, that if you are playing oil, maybe move from WTI to Brent, and it's still, prices are still going to go up if they're going to go up. If WTI is going up, it's because Brent is going up as well. They're not going to go in opposite directions where WTI goes up and Brent goes down. But if that export ban does come in, if he does make a move, you avoid the widening gap between Brent and WTI. On Wednesday, my video is out. It is called The Ice Age. Ice Age is not over. I'm finally done. I'm just putting some finishing touches on it. It expanded to be way, way, way too long, and there were just these rabbit holes I kept going down that I kept, looked at, said, okay, let's just shut this down, shut this down, shut this down. The storyline runs this way. But I just kept going off on these tangents about battery chemistry, supply of materials, what countries they come from. That's not the story that needs to be told. I can tell it by using bigger, broader themes. And on this one, I'm going to give you a 2023 and a 2024 year-end price target on Tesla. I'm going to give you a year-end target on both of those. If you're a Tesla fan, you may not want to listen. Trigger warning, you may not want to listen if you're a Tesla fan. It's going to be a realistic target, not a ridiculous target, but a realistic target. But you're probably not going to like it. And just to give you some idea of what I'm thinking on this, in 2007, August of 2007, I had given a presentation on RIM, Research in Motion. They were sitting at about 130 a share, and I forecasted that within 2 years they would be a shadow of themselves. I said, give it 1 year and they'll be down 50%. They'll be $65, and a year after that they will be less than 10% of that. That this is a dead company walking. I got laughed at, completely laughed at, until I was right. Beyond Meat, sitting around $145 when I put a video out, and I said the fair price on this is somewhere between 15 and 20 bucks. And you can go to those two videos. One was called Big Bear Little Bull, and another one was I think BYND was in the title. And look at the comment section and the name calling and how stupid I was, and Boomer doesn't get it, whatever the case is. Well, it's sitting at about 25 bucks right now. I think Goldman Sachs price target is 14 bucks. Lots of price targets I've seen between $12 and $25 on this one here. Tesla is no different. The difference, what happened here was, it is these two, along with many others, is the story of competitive dynamics. It happens to all industries. It's not as if it's company specific. It's not as if, well, this company's bad, that company's bad, and this product sucks, and that no, it has nothing to do with that. It comes down to the economics of competition, plain and simple. That all great markets will get taken away from you. All of them will get taken away from you. It's just the history of the economics of competition. So just to let you know that the price targets on here, you're probably not going to like if you're a Tesla fan. Anyways, that'll be out Wednesday, sometime around midday. YouTube gives me these statistics that tell me what the optimal time to put a video out is. And they also, give you things like saying, don't put two out on the same day because you're only going to step on the first one. So this is coming out today. I was going to put this one out on Friday, this one here out on Friday. But then I had this one coming out on Sunday, and I thought, well, if this one comes out Sunday, I'm only going to step on this one. So I'll put this one out Wednesday. So you have that to look forward to. That'll be out Wednesday, and that's it. That's all I got this week.